Look, most beginner traders completely misunderstand why they actually fail. They think they blow their accounts because they can't find a good setup, or maybe because they don't have some secret holy grail strategy. But honestly, that is completely backwards. They fail because they totally ignore risk until their account is already in shambles. Risk management is not the boring part of trading, it is the absolute foundation of your survival in the markets. So today, we're breaking down the most common risk management mistakes that are quietly destroying your account and exactly how we're going to fix them. Let's get into it.
There's a quote from Umar Ashraf that really hits the nail on the head here. He says, "Our job as traders is to manage risk. How you manage risk will ultimately identify how you perform." You see, as a beginner, you're naturally in a reward mindset, right? You enter a trade and immediately start calculating how much money you're going to make. But professionals, they enter a risk-protective mindset. They calculate exactly how much they can safely lose. Survival absolutely has to come before profits.
So you really have to ask yourself right now, are you trading to profit or are you trading to survive? Because if your risk is completely uncontrolled, even a fantastic strategy with a super high win rate will eventually bleed your account dry. I mean, you could have 3 amazing trades and then just hand all your capital right back to the market on the 4th simply because you threw your risk parameters out the window. Uncontrolled risk is literally the silent killer of good setups.
Proper professional risk management is an active daily process. It means identifying potential risks, assessing their impact, and actively mitigating them before a trade ever even flashes red. It is definitely not something you just figure out while the market is actively moving against you. Think of it like the armor you strap on long before you ever step onto the battlefield.
All right, let's jump into our first category of mistakes: sizing and stop-loss errors.
The absolute first major mistake we see is exposing your account to wildly different risk amounts per trade. One week you're risking $50, the next day 500, and then suddenly 2,000 just because you feel really confident. Doing this completely destroys the math of trading. The fix here is setting a fixed mathematical standard, typically risking just 1% of your account equity. So if you have a $50,000 account, your maximum risk per trade is exactly $500. Sticking to a standard like this guarantees a single bad trade won't wipe out days or even weeks of hard work.
Moving on to mistake number 2, trading without a hard stop loss. Beginners love to say, "Oh, I know my stop level, I'll just exit manually if it gets there." That is a hope-based, extremely emotionally fragile mental stop. Sure, it might work 80% of the time, but that other 20%? During fast market moves, unexpected news events, or just a moment of hesitation, your account takes catastrophic damage. A hard stop loss is automated and mathematically bound. It protects your capital when your own emotions try to sabotage you.
Then we have mistake number 3, which is using the exact same position size on every single trade purely out of habit. Listen, your sizing must dynamically adjust based on the specific risk of that trade. You take your account equity, pick your risk percentage, like that 1% we just talked about, and divide it by your stop-loss distance. A wider stop means you need a smaller position size. A tighter stop, that allows for a larger size. Always remember, size is based on risk, not habit.
Okay, moving into the next area, the psychology of losing. Mistake number 4 is trading without a daily loss limit, and man, this one triggers a deadly spiral. Here's how it goes. A single bad trade causes frustration. Because you don't have a pre-planned limit, your discipline breaks. 1 loss turns into 2, 2 quickly becomes 4. You refuse to accept a red day, and suddenly that emotional spiral turns into a completely blown account. A daily loss limit tells you exactly when to walk away. Once you hit it, close the platform. You're done for the day.
And that leads directly into mistake number 5, which is incredibly toxic: sizing up right after a loss. When you're down $1,000, it is so tempting to think, "I'll just double my size and make it all back in one go." Let me be crystal clear here. Increasing size to win money back faster is just revenge trading disguised as confidence. If that trade goes against you, you are now in a hole you simply cannot dig out of. You have to protect your discipline. Don't try to force a miraculous recovery.
Next up, let's talk about ignoring drawdowns and data.
Mistake number 6 is ignoring your overall account drawdown. Most people are terrified of the sudden blowout where massive revenge trades just nuke the account in a single day. But honestly, the real danger is the slow bleed. This happens when you aren't taking huge, flashy losses, but you are taking dozens of oversized losses compared to undersized wins. Fast forward 3 months, your account has bled out 30%, and you don't even know why. And the reason you don't know why is because you failed to track your metrics. So why does that slow bleed actually happen?
That brings us to mistake number 7, failing to track behavioral errors. Studies actually show that when traders use manual spreadsheets, their journaling compliance is fantastic in month 1, but then it drops off faster than a gym membership in February, literally plummeting below 40% by month 2. Think about it. When you lose $1,500 on a Wednesday, the absolute last thing you want to do is manually type out all your mistakes. So you skip it, and naturally, you make the exact same mistake again on Thursday.
All right, so how do we actually solve this? Let's talk about fixing habits with TradeZella.
TradeZella tackles these exact 7 mistakes head-on by making your risk execution completely measurable, without the exhausting manual data entry. It automatically syncs with over 500 brokers, tracks your risk per trade, monitors those crucial daily loss limits, features AI-powered session reviews, and it even has a groundbreaking tick-by-tick trade replay. It's basically a central command center for your trading discipline.
The trade replay feature is an absolute game changer. You know how when you look at a static chart at the end of the day, every exit looks totally obvious in hindsight? Well, Trade Replay lets you rewatch your execution tick by tick using 1-second data. It fully restores the raw uncertainty of live trading. You can watch the exact second your discipline failed and clearly figure out if a panic exit was a smart, rational choice or just an emotional break of your own rules.
And then there's Zella AI. This is not just some basic chatbot. It is the ultimate built-in trading partner. It automatically tags your trades, summarizes your sessions, and catches those sneaky behavioral patterns you completely miss. For example, it might tell you, hey, you break your position sizing rules 40% more often after 2 p.m. Finding that insight manually would take hours, but Zella AI surfaces it instantly so you never skip a vital performance review.
So, if you are tired of bleeding capital and repeating the exact same risk management mistakes month after month, you really need to automate your discipline. Right now, you can get 20% off all TradeZella subscriptions by using the exclusive promo code WR20 at checkout. Seriously, stop relying on manual spreadsheets that you're just going to abandon after a month anyway, and start fixing your account today with a tool built for serious traders.
Look, every single trader on Earth faces losing streaks. It's an absolute guarantee in the markets. But how you handle them, that makes all the difference in the world. So I'll leave you with this. Will your next loss be a small, calculated cost of doing business, or will it be that uncontrolled, emotional trade that finally wipes out your account? Master your risk, and you master the markets.